Gold has just broken above $5,000 per ounce for the first time in history. Prices have since pulled back slightly, but they remain far above last year's levels. So why has gold risen so sharply? And why has it suddenly shown signs of short-term weakness? The answer lies at the intersection of geopolitics, central banks, and market fear. One of the strongest forces behind the surge in gold prices is growing political uncertainty across the global economy. Trade disputes, tariff threats, and unpredictable policy decisions have weakened confidence in equities and major currencies. In particular, uncertainty surrounding United States trade and foreign policy has pushed investors toward assets that are not directly tied to political decision-making or sovereign risk. Gold has historically played this role. When trust in governments and institutions declines, gold becomes a neutral store of value, outside the reach of policy shifts. Ongoing military conflicts have further strengthened demand for gold. The war in Ukraine, instability in the Middle East, and rising tensions between major powers have created an environment where capital preservation has taken priority over growth. In such conditions, gold functions as financial insurance. It does not depend on economic growth, corporate earnings, or central bank credibility. Its value rises when uncertainty dominates global headlines. Another critical driver is the behavior of central banks. Over recent years, many countries have increased their gold reserves while reducing exposure to US dollar assets. This shift reflects lessons learned from sanctions regimes, where foreign exchange reserves held in dollars were frozen or restricted. Gold carries no counterparty risk and is politically neutral. Although central bank purchases slowed slightly during 2025, total demand remains far above pre-2022 levels, creating long-term structural support for gold prices. Demand is not limited to central banks. China remains the world's largest gold market, driven by both jewelry demand and investment buying. In Western markets, capital has flowed into gold-backed financial products and mining equities. A newer development is alternative financial actors accumulating physical gold as part of reserve strategies, including asset-backed currency issuers. This has tightened supply in an already constrained market. Despite strong fundamentals, gold has shown sharp volatility. After breaking above $5,000, prices corrected lower. This pullback was largely driven by shifting expectations around US monetary policy. Earlier fears of aggressive rate cuts and inflation boosted gold demand. As expectations moved toward a more predictable policy outlook, some of that pressure eased. This is an important reminder. Gold is a safe haven, but it is still a traded commodity. Even after the correction, gold prices are still roughly 65% higher than 1 year ago. That confirms the broader drivers remain intact. Geopolitical risk, trade tensions, and concerns over fiscal sustainability continue to support precious metals. Silver has followed a similar pattern, rising sharply, then consolidating, reinforcing a broader shift toward tangible assets. Gold's appeal is ultimately rooted in scarcity. Supply grows slowly and cannot be expanded through debt or monetary policy. That makes gold attractive when confidence in paper currencies weakens. Recent volatility is a reminder that gold is not risk-free. But as long as the global economy faces geopolitical fragmentation, rising debt, and political unpredictability, gold will remain closely tied to demand for security and stability.